You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
In this episode, we share our outlook for commercial and residential construction in Europe.
In terms of commercial real estate in Europe, I'll touch on our latest forecast for non-residential structures in both Western and Eastern Europe. To start with Western Europe, we now expect non-residential structure spending across the region, which also covers the UK, to fall by 0.5% this year. Growth forecasts for the eurozone have deteriorated. We expect eurozone to enter into recession in the second half of this year. We also expect the lagged effects of tighter monetary policy to feed through into lower activity and demand. At the same time, construction costs still remain relatively high across many markets, even though we've seen building materials come down from their highs in recent months, as we've seen in our PMI data, whilst labor and skills shortages remains a major issue in many markets. The outlook for non-res structures is largely shaped by offices, and here we do expect growth to remain relatively subdued this year, with a rise of only 0.2% due to some of the macro headwinds that I've just mentioned, but also structural factors that remain at play that were also been brought up by the pandemic. Following the pandemic, we have seen a shift in working patterns towards hybrid and remote working, and this has led to a drop in demand for office space and in terms of their values as well. Many real estate firms in Europe have been reporting a decline in demand for office space. In the first half of the year, take-up levels were pretty much down across Europe, particularly in German cities. Given the weakness in demand and as well as high borrowing and construction costs, developers have raised concerns about viability of schemes as well as profitability in many. And as a result, we do expect some of these schemes to be pushed back into 2024. Having said that, we are seeing growing demand for high quality and sustainable space driven by flexible working patterns as well as ECG requirements and EPC regulations. And this should support a pipeline of renovations and refurbishments of existing office space in the near term and also more into the medium term as well. In terms of commercial, construction spending here is expected to decline in 2023 and 2024, given weaker economic conditions and high construction costs. Both retail and hotels and restaurants are expected to see sharp slowdown in spending growth in the near term. Retail would additionally be affected by some of the long-term structural shifts towards online shopping that we've seen even before the pandemic and is lowering demand for retail space. Turning to Eastern Europe, the narrative is pretty similar over here. Non-residential structures growth is expected to slow across the region to 1.7% this year, as economic conditions weaken across many markets, and high financing and construction costs dampen sentiment and activity, especially in offices. Offices construction growth in Eastern Europe is likely to slow to around 3.8% this year, as investors are largely taking a wait-and-see approach given the uncertain economic climate and high interest rates. Similar to Western Europe, we are seeing a flight towards quality assets, and we're likely to see this trend continue as we move into the medium term as well. Commercial investment, unlike Western Europe, is expected to see sustained expansion both in 2023 and 2024, and that is despite some of the economic headwinds that we're seeing. There are pockets of activity that we're seeing here, particularly in relation to refurbishments and renovations of older retail properties, such as shopping centers, as well as developers are prioritizing the development of new retail parks, which should support growth in the near term. Hotels and restaurants growth should be supported by an improvement in tourism numbers, as well as resilient domestic demand in some of the markets. In the region, central banks have begun or are expected to start monetary policy easing from the second half of this year, and this should support a pickup in demand and activity levels as we move into 2024. So some of the weakness that we expect in commercial and offices, especially in Western Europe, is largely in line with what we're seeing in the leading indicators of activity, especially our PMI data. In the eurozone, the PMI data has shown that construction has remained on a downward trend in the first half of this year, and this continued in the third quarter as well. All three segments of construction, residential, commercial, and civil engineering have been reporting declines. Commercial activity fell sharply as well at the end of the third quarter. In the UK, the PMI data show that construction tipped back into contraction at the end of the third quarter. Commercial activity also declined. That's after 7 consecutive months of growth, which was partly due to office refurbishment projects. So given the weakness in the PMI data, we do expect commercial activity to decline across the eurozone and the UK in the second half of this year, and other indicators do suggest further weakness ahead, especially the building permits data for both the EU and the eurozone showed a decline in the first half of the year in terms of non-residential buildings. Sharp falls have been reported in Czechia, Slovakia, Slovenia, as well as in Germany. A breakdown of the data shows that this is largely driven by building permits for offices. Both offices building permits in the EU and the eurozone fell sharply in the first half of the year. Again, notable falls have been seen in Eastern Europe, European countries, as well as in Germany. In terms of the UK, the volume of new orders for private commercial properties declined by around 18% in the first half of this year in annual terms. This was largely driven by falls in both offices and retail new orders, which fell by around 8% over the same period. Entertainment new orders also declined by around 35% in the first half of this year. So given the weaknesses we're seeing currently in the indicators such as the PMI, building permits and new orders, we do expect further weakness as we move into 2024. So that's it from a commercial side of things for Europe.
So the Eurozone housing market has turned a corner in the fourth quarter 2022 as the higher interest rate environment and the tighter financial conditions have finally caught up with the market. Eurozone house prices have actually declined for 3 consecutive quarters now and are down 2.6% from their peak on average. Now, the speed and intensity of this correction in the Eurozone housing market varies by country. There are several factors that affect the speed and intensity. So, for example, the degree of imbalances accumulated in the last decade. That would include how much house values are detached from fundamentals, such as incomes and rent, and how strong house price growth was accompanied by debt growth. Germany and Luxembourg here are really a good example because both were most overvalued housing markets in 2021. They are now actually leading the decline in nominal house prices. As of the second quarter this year, German house prices are down 10% from their peak, and in Luxembourg, over 8%. Another factor that affects the speed and intensity of any correction in residential housing markets is the average mortgage fixation period. So mortgage holders in countries where variable rates are prevalent will feel the pain of the ECB rate hikes and also moves in bond markets a lot quicker than those where 2, 5, or even 10-year fixes are more predominant. So if we look at Finland, again, it's a great example because over 95% of mortgage holders there have fixed their mortgage rate for less than a year. So they felt the pain from these rate hikes very quickly. And as a result, house prices are down 6% from their peak, which is the third largest drop in the Eurozone. Now, other countries such as Spain or the Baltics have not yet recorded any declines so far. But even there, we can see waning activity in housing markets. For example, transactions are falling. And across the Eurozone, we see anecdotal evidence of a lock-in effect, which is a situation where homeowners who are currently on very low mortgage rates, they want to stay put rather than move on and buy their next property just to keep on that low mortgage rate and not increase their monthly payments. What this does is it reduces the available inventory and it can effectively bring the owner-occupier housing market to a standstill. And that can also lead to quite volatile price movements, particularly in monthly data that we have for some countries. Now, to determine where we're going from here, we should look at a couple of pressure points and supporting factors that affect household budgets. So one of the pressure points is the fact that the 400 basis point hikes so far by the ECB have not yet been fully transmitted to mortgage holders due to this differing prevalence of mortgage fixation rates that I talked about earlier. The average mortgage rate has already risen by around 350 basis points in countries where we have a lot of more variable mortgage rates. So that would be in the Baltics, Finland, or Portugal. Now, over time, we will see more and more people come to the end of their initial mortgage fixation period. And now they find themselves confronted with a higher rate environment, which translates to higher monthly repayment burdens. And that would put pressure on their wallets. And this headwind won't ease for a while because we don't expect the ECB to start cutting rates before June 2024. And even then, we don't expect a return to the zero lower bound rate environment that we had in the past decade. Persistent inflation is another headwind to household budgets. So while in September, we saw the average annual headline rate ease to 4.3% in the Eurozone, and alternative metrics also improved. we don't project the headline rate to sustainably return to the ECB's 2% target before the end of next year at the earliest. Tight labour markets currently continue to support actually upside risks to this call, as does the recent rally in oil prices. So overall, household purchasing power will remain squeezed for a little while longer. Now, despite these pressures on household budgets, a severe increase in defaults on mortgages remains a tail risk, and there are several reasons why. So first, underwriting standards remain a lot tighter than before the financial crisis. And second of all, far from actually being solely a bad thing, the higher policy rate environment can actually benefit countries through higher net receipts on their assets. So what we've seen during the last decade, when monetary policy was operating at the zero lower bound, we saw that the compression of receipts on assets outweighed that on debt repayments. What that essentially meant was that countries that had relatively highly indebted households with low interest-bearing assets, they gained the most from this policy environment because it yielded significant payment reductions on their debt as rates dropped, but only a moderate drop in terms of their receipts. And on the flip side, households in a more comfortable wealth position, so those who had more assets and liabilities, they lost more income. Now this has changed. With the surge in interest rates that started last year, interest-related flows have started increasing in the eurozone, and the net effect in most European countries is actually positive from these rate hikes. And we expect this trend to continue and even intensify further as these higher rates fully diffuse to household receipts and payments. Not only is household resilience bolstered by these returns on assets, but actually also from wages. And this again limits the number of defaults that we're expecting in the residential housing market. So several different measures for the Eurozone show nominal wage growth currently around just north of the 4% year-on-year rate. And while we do expect a softening in the labour market in the coming quarters as economic activity wanes further, overall large spikes in the unemployment rate are not our base case. And as such, labour markets will remain tight and there will be upward pressure on wages. We don't expect wage growth to return to the pre-pandemic levels we've seen before 2025. And now, with inflation falling steadily in our forecast, real wage growth will actually turn positive later this year, and this will support household balance sheets, of course. Now, looking forward, overall, we project a nominal house price correction in the Eurozone by an average of 10%, drawn out over a 2-year period, not least because mortgage demand is currently at its lowest since 2013. However, while these higher mortgage rates and lower affordability suppress demand, the housing supply constraints actually make house prices quite inelastic. So Europe already had a housing shortage before inflation started rising, before interest rates went up, and even before the war in Ukraine triggered another influx of refugees. These supply shortages are currently being exacerbated by the slowdown in residential construction that began last year. And with housing investment weakening for multiple quarters now, and we see building permits, they have fallen to levels below what we've experienced before the pandemic. This really bodes quite well if you are invested in the housing market in Europe, because fewer houses will be constructed now. The housing stock will thus not keep pace with population growth, and pressure on the housing market and the stock is being amplified. So in short, we see a correction in the Eurozone housing market by about 10%, but the severe housing shortage will pose a floor to how much prices can fall and should ensure that nominal prices remain well above their pre-pandemic levels.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.